Good afternoon, everyone, and good morning to our West Coast participants. My name is Scott Munn. I'm joined with my colleague George Soiree today to conduct our webinar, Topics Arising from Recent Disruptions. This webinar will run for 1 hour. So let me take you through some of the technical aspects. You folks are in listen-only mode. You can submit questions through the Q&A function. The event will be recorded and available on the ICD website within about 24 hours. If you have any technical questions, please reach out to Kim Carthy. She can be reached at kcarthy@icd.ca. With that, let's jump into the webinar. So today we're going to cover a few things. First of all, we're going to look at what's happened so far, really in response to COVID-19 and the economic implications of the surge in cases last spring. Then we're going to talk a bit about what are boards looking at today and how are they preparing for year end, as well as any relationship to shareholder communication. Finally, we'll take a look at how do you set goals for fiscal 21? What are the implications of this year's results on next year's goals? The last couple of components will be ESG and diversity and inclusion and how they're coming into the conversation regarding compensation this year. And lastly, we'll get to our Q&A segment, which should last 10 to 15 minutes at the end. So George and I are joined by Joanne Firstman and Jennifer Corey. Joanne sits on a number of boards, Dream Unlimited, Cisco Gold Royalties, Cogeco, and ATS Automation. Jen chairs the Compensation Committee at Crescent Point. She is also the chair of the Global Innovation Coalition for Change, run by the UN Women. She's got an executive role or previous executive roles at ExxonMobil and BHP. George and I are partners with Hugeson Consulting. We advise boards on executive compensation, corporate performance measurement, and pay for performance alignment and all the related governance. We, of course, work with clients in Canada and the US and a little bit in the UK, private companies, public companies, crown corporations, so a whole range of different organizations. We are very pleased to support the ICD. We've been doing this for a number of years now. We're joined with Laurie Brotherton and Salam Tessegay from the ICD. So with that behind us, let's talk a bit about the actions that have taken place so far. What conversations have already happened? Well, we saw early on, and this came through both in preparing for today's webinar, as well as the client work that we did earlier in the year, and frankly, the literature that came out. Context matters a lot. We have seen that there's some industries that have actually done well in this environment, some that have been fairly stable, and some that have suffered fairly difficult times over the last few months. And even within industries, how organizations have performed and responded and pivoted, that word that we all use these days, really varies. Overall, we've seen a fairly wait and see approach. A lot of boards looking to gather as much information as possible before they respond, and yet I'm sure communicating with management as they go along. There were some early exceptions, and we'll talk about these a bit today. So what happened to the folks that don't have a year end? That's December. And in particular, those folks that had a March or spring year end, where they might have seen some unexpected financial results in the last 1 or 2 months of their year, and the need to fairly quickly think about how their performance goal setting and budget would look like for fiscal 21. So let me give you one slide that shows a little bit of this. You can see here the consumer discretionary results in the US were fairly meaningfully impacted right from the very beginning. At the other end of the spectrum, the utility sector was fairly stable. Another piece of today's webinar is that in preparation for it, we asked a number of folks that signed on today to give us some information in advance of the webinar. And so as we're going along today, we'll do our best to summarize the information. So one of the questions we asked was, what actions has your company taken in 2020? And so this is an interesting slide. It shows us that in terms of salaries, director compensation, in-year bonus programs, roughly 22 to 28% of the folks that responded have taken some action already. And about 7% took a look at long-term incentives. On the other hand, we've got 38% that are taking a wait and see approach, and 27 that have done nothing so far. So a bit of a mixed bag between folks that made adjustments already and the folks that haven't. So with that, I'm going to pass this over to Jen first. Jen, hoping you can talk to us a bit about the conversations you've had already as you're thinking about your response to COVID.
Thanks, Scott. Happy to be here with you today. It's nice to have all these colleagues. We're all in the same boat and sharing ideas. One of the things that we've done, I'll take you back to March and maybe give you a little bit of a chronological order of what we have seen and many boards have seen. In March, it was all about battening down the hatches and preserving the balance sheet. Capital costs, operating expenses, supply chain, sending people home, preparing for work at home. And we started weekly meetings with our board, between the board and the CEO and other members of management. In April, it was all about, thinking about org structure and review and, what else can we do? We cut salaries, both for executives and directors. We'll all remember April 27th when the WTI for the first time in its history was minus 37.63 WTI a barrel. And we also started kind of looking at our 2020 scorecard at that time. Like, what are the things that are within management control without not within the control? May and June, we saw layoffs probably in a variety of sectors, I know, across Canada. And also meetings started with the board chair and myself, as well as the CEO, on how are we going to think about performance this year. That was way back in May and June. In July, at our board meeting, we started talking about, again, how are we going to think about performance this year and the notion of discretion. And we'll talk a little bit more about that later. And, in September, again, going into year end, I've had conversations with many of my board members, as well as the CEOs of organizations I'm affiliated with, just to get their feel for where's your head at around 2020. So one thing I will just leave you with is that I believe that management teams have just done an overwhelmingly positive effort on responding to COVID. I know the companies I'm associated with have, and I think there's many others that have, and it's been quite exceptional.
Great, thank you. Joanne, I might pass it over to you. You are associated with a company that has a non-December year end. So maybe you could talk a little bit about that experience.
Okay, thank you, Scott. I mean, for most of you that have December year ends, obviously by the time 2020 compensation decisions need to be made, boards will have a much clearer picture of the impact of COVID on their companies and how management has handled the crisis. And more importantly, if there's any changes to the corporate strategy that are needed for the future. As a result, boards, should be in a position to assess the events of 2020, the executive performance, and why targets either were or were not met. For my March year-end company, decisions related to the STIP payout and the 2021 targets had to be made in the early days of the crisis, when business uncertainties and employee stresses were at their highest, and we didn't have the luxury of waiting out the year to see what happened. As you all recall, those early days, boards were, primarily focused on the health and safety of the employees, the company's ability to function from working from home, and, ensuring the financial viability to weather the storm. It was probably the worst possible scenario to address executive compensation discussions with management. I'll talk further later on about some of those details, but I want to point out a few of the lessons learned from this experience. The first is really listen to your CEO as he or she explains the working environment, and be very sensitive and empathetic to the situation that management finds itself in. Secondly, focus on the key people. And in this very volatile and dynamic environment, how do boards ensure that the key employees today will be the right leaders for the future, recognizing that the business model may be evolving. Are you considering upgrading or changing key personnel? And that will be an important element to your decision making. Thirdly, try to look at all aspects of compensation together and not any one in isolation. You may have a problem with the STIP payout that you want to address, but a few months later, you may have another problem with an LTIP or something else. And you want to make sure that, all changes are being addressed and there's no expectation that every time, you're going to come back, management can come back and ask for new things. Lastly, what was very important in this case is that our advisors, we relied on our advisors to help not only bridge the communication gap with management, but to bring concrete industry data and experience and pro forma analysis to help the board make informed decisions.
All right, thank you.
Thank you.
George, over to you to talk about discussions boards are having now.
So here we are, it's almost November. That wait and see approach is coming to an end. Now, all the companies with calendar year ends are in the middle of getting ready for Q4, end of Q4 decisions. And so in this section here, we're going to now focus on, what's going on right now and what are the key things that boards and management teams together are doing. So if we advance to the next slide, let me set up a little bit of the framework that we've seen at play in across the various industries. And so really, compared to normal or regular year ends, what's different? We're seeing two things that are different this year. One, boards and management teams are getting together. They're agreeing that the process has to be more robust. What do we mean by that? Planning on more meetings, planning on more information that should be available for decisions, and more touch points, essentially, so that when it comes time, either at the very end of calendar 2020 or in January, when it's time to score the incentives, whether it's the short-term or the long-term incentive that's maturing, will you have the right information in front of you? And then the kind of information that's being asked, so what are the questions that includes stress testing, but like what happened? Like what was the impact on the business that really was due to COVID maybe and due to other factors? Clearly understanding what's been happening to the compensation programs before, absent COVID, but then with the impact of COVID, and doing some forward testing as well. And we'll get into that in a moment. So, but these are the things going on. Let me just show you, we had great response before this webinar started. People, we had several hundred people actually respond to the survey. So we got a pretty interesting result. If you go to the first of these questions, one was, if you're going to use discretion, what's the audience feel? Are people going to be using discretion or not? And interestingly, just over 40% of the audience said that it's still too early to tell. 13%, so only a small percentage, said, no, we know already that we're not going to exercise discretion. And then the rest of the answers were split. Interestingly, half saying, oh, we're likely going to look at positive discretion, others saying negative discretion. Very interesting. Then we said, if you're going to exercise some kind of discretion, especially let's say you're going to put more money on the table because the scorecard got blown to zero, and zero may not be the right answer. If you're going to put more money on the table on a discretionary basis, what might the approach be? Will it be a one team approach in terms of applying those extra dollars to the eligible population, or might it be differentiated by level? So very interesting feedback from the audience. So now the hard part, Jen, I would ask that maybe you share what's happening at your boards on how you're thinking about whether or not to exercise discretion, and if so, how will you do it?
Yeah, it's a great question, George. I think now more than ever, most boards and management teams are thinking that there will have to be some kind of discretion applied. So one of the things that I've seen is actually the board putting together a set of what we're calling discretion principles. So what are the questions, what's a guideline, and what are the questions and criteria by which the board is actually going to stare at in order to think about how to apply discretion. So one of the things that we've done at Crescent Point is talk to both management and the chair and the board and said, are these things that we should be using as almost like guideposts as we go into year end to apply discretion? They're not hard and fast rules. I know another couple of organizations I'm involved with and not-for-profits are doing the same thing. It just allows the board to have some kind of criteria. I think, as we think about what has gone on in industry, again, context matters. When we think about the things like salary cutbacks and rollbacks, are they temporary? Are they not? What to do with target? Do you pay out at target if but for COVID, they've achieved target, et cetera? I think we're in a real dilemma, and much to the points that Joanne has made is that on one hand, management has probably not worked harder than they have this year in all the things they had to do and the sacrifices they had to make. On the other hand, the shareholders and employee experience, and in fact, the economy has been extremely unstable with thousands losing their job. As well, you want to consider retention. To Joanne's point earlier, if you've got key management and staff that you want to retain in this kind of environment, you have to think about what's out in front of them in terms of retentive compensation. So, when I think about base salary readjustments or STIP targets versus other things to think about, discretion is going to have to be applied, but it's probably going to have to be applied on the whole thing. Taking all of the components of compensation in consideration. Last, I would say is that certainly for the energy industry, at least in the short to longer term, we've got compression on compensation packages due to investors, oil prices, et cetera. The US election and how that'll affect businesses in the energy industry, and also COVID. So all those big things are also things that you're going to have to consider, but it has to be applied, I think, in concert around all components of compensation. And discretion, you need something to hang your hat on. So these principles, I think, are a good idea. And we started with our delivering those through Hugeson. They gave us a draft. We shared that with the chair. We shared that with our management team and CEO, and we've agreed that these seem right. Again, not hard and fast, but principles we can use.
Excellent. Hey, Joanne, maybe you could also share what's happening currently.
Thanks. Firstly, I couldn't agree more with most of the things, well, all of the things that Jen said, but more specifically in relation to, how hard management has worked and the effort that was put in by management teams that I am lucky enough to work with. And I think that a lot of the themes here is like the balancing act between, doing the right thing for employees and balancing also, the value for shareholders, and keep, the board making sure that those two overriding criteria are kept at the forefront of any decision making. I'm now going to talk a little bit more of some of the details of decision making for the STIP and LTIP issues that I've seen so far this year. Obviously, many companies are facing the reality that this year's STIP and LTIP targets that were established pre-COVID will not be met. And at the same time, like we just said, our management teams are under enormous pressure to navigate the business through this period of uncertainty, to take care of employees, to continue to operate seamlessly in this work from home environment, and to develop and execute business plans for the new normal. All these things, I think, need to be considered when assessing this year's STIP and LTIP achievements. I'll talk first about the STIP. for senior employees, this cash bonus represents up to 50% of their cash compensation. So it's a material, very important part of their annual cash compensation. And Jen mentioned some very, very interesting concepts about discretion, but sometimes boards are uncomfortable with the whole discretion precedent. And sometimes there's maybe other softer or easier things that you can do, which would still achieve the same results. So for example, the STIP metrics are usually management calculated figures and not just plucked off the financial statements. And therefore they do require some judgment in the calibration methodology. I think that boards can assess, things like one-time events or timing differences, non-cash items, and other abnormalities, and make decisions as to whether those things should be included or excluded from the calculation without actually changing, putting a discretionary and changing the formula completely. Secondly, there is often a personal component or other qualitative aspects of the formula, which, due to COVID considerations, boards can look at more favorably this year, and obviously certainly adjust and increase the personal component or the achievement of the personal component. As the STIP payout also normally coincides with setting the new STIP targets for the coming year, I think it's a tremendous opportunity for boards to fix any of the current issues with the STIP formula and have a more relevant plan for the future. I'll give a Winston Churchill quote, "Never let a good crisis go to waste." It is something that a lot of my boards have already talked about and have already looked into. Is, last year may not have been perfect and may not have given the desired results, but we're going to make sure that next year makes sense for everybody. I'll now move on to the in-flight LTIP awards. And again, for companies impacted by the pandemic, it's likely that the performance criteria established at the beginning of the vesting cycles, which could have been either 1, 2, or 3 years ago, will not be met, or more importantly, may not be relevant. Furthermore, if the share price has also been hit since the grant dates, the value of the award that will vest will also be diminished. LTIP awards are meant to be long-term retention tools for key employees and a mechanism for them to participate in the share appreciation that their hard work and efforts help realize. So if the LTIP vests are tracking significantly below targets, the question is, has the link with the employee motivation and retention been lost? And while it's important for boards to continue to link pay to performance, I think employees must also see a pathway so that, if they have a material reduction in value, they see that their value can be restored if performance conditions are met in the future. So I've experienced 2 companies so far with in-flight LTIP concerns. And, there were fulsome discussions at the board level, and in evaluating what to do, here are some of the things that our boards considered. So firstly, back to what I said, something I said earlier, like, who is the key employee group today? Because that group may not have been the key group when these in-flights awards were originally granted. So 2 or 3 years ago, you may have had a completely different group of people. So if you do something to help realize the vesting of the older awards, is the benefit accruing to the right team members today? So that's a very interesting discussion to have with your CEO on that front. The second thing is that LTIP targets are, 3-year targets, and they're there because management and the board to both understand, what's acceptable and what's exceptional for the business, and how payouts are going to go from there. And it provides a discipline for management in pursuing the plan. You're never going to get a 3-year target right. And there's always going to be changes that happens. And there'll be years with windfalls and years with misses. So, what we did in one instance was we actually tracked the actual versus realized target LTIP vests over a number of years prior to 2020. And we were able to demonstrate that in a number of years, the payouts were significantly higher than target. And even if you factored in the 2020 year, that is tracking negatively, the overall 3 to 5 year realized value was averaging above target. So in that case as well, obviously our advisors were very helpful in helping prepare this detailed financial analysis so that we were able to make informed decisions. In both of those cases, we decided not to do anything for the in-flight LTIP calculations for the, mostly for the reasons I spoke about. However, we did consider both increasing the current year's LTIP dollar value grants and or issuing special retention LTIP awards to key employees, and not necessarily to all key employees to the same extent. The boards felt much more comfortable with these approaches, firstly, because you could ensure the extra award is given to the right people, and secondly, because the 3-year vesting does provide for a longer retention period than the current in-flight rewards. Back to you.
Fascinating. Yeah, fascinating ranges of issues. I'll share a couple of other examples to bring to life for the audience how the facts really matter. The circumstances of the industry matter, and the circumstances of a particular company in the industry matter. And I think one, and I'll be interested in your reaction, but I think what all directors and managers have to be wary of is if you hear, oh, this company over here made a discretionary adjustment this way, that you translate that automatically to your company. Well, maybe not, because their fact pattern could be very different. I'll give you 2 examples. I've seen the story in the US. Nike has a May 31 year end. And so they published their circular in June and July, and they had their annual meeting. And they display, of course, that their operations were hit negatively in their fiscal 4th quarter leading up to May. And they're very clear about that. And as a result, both their STIP that was paying out at the end of May turned to 0. Also went to 0. And they said, we didn't adjust. They went to 0, that's it. We didn't meet our test. Now, in the same breath, then they issued very, very, like millions and millions of dollars in special grants to these executives, but in size. There were other issues going on with Nike in terms of a change in CEO, but the fact is that went over like a lead balloon, and they ended up almost failing their stay on pay. I'll go all the way to the other extreme. Here in Canada, Empire, which owns Sobeys supermarkets, they have also a May leading up to March, right before COVID. They were on track for target performance. And one of the few companies, they actually got a tailwind from COVID because everybody started to go to the grocery store. And so their volumes and profit accelerated in the last couple of months of their fiscal year. So they beat their forecast, and they ended up with a score in their incentive program of near max. And they decided at the end of that, they said, well, what do we do? And they came up with a very nuanced answer. They said, well, for our senior executives, we made the decision that they don't need or they shouldn't get the benefit of that because in part, it wasn't them that caused, they had no line of sight to the superior performance. Having said that, in the same breath, they said, but for all the other eligible employees, they will get the benefit of this superior score. And because they were out in the field, they made it happen, and it was extraordinary circumstances. So very, very different. And they got, by the way, very strong support from the shareholder. So it's going to be very difficult for every board to really, where they are thinking of exercising discretion, how to do it. And maybe we can come back a bit later because this is one that we could talk about, forever. But just wanted to share that there's a very wide range of things happening. Scott, if we go maybe now to the next topic, and this is really paying attention to the stakeholders. And I'm going to ask Jen and Joanne to comment here in a minute. But the question here is, of course, whether you're a private company or especially if you're publicly traded, as you make these decisions, of course, the shareholders are watching. And they're always curious to know how well is the board exercising its judgment on compensation matters. This year, it'll be there in spades. And the ISS and Glass Lewis's of the world have said so. But interesting, it's unlike the financial crisis where it was really quite shareholder oriented. Now there are a lot more stakeholders that matter, starting with the employees. How are they going to view this? Customers, etc. So maybe I'll hand it over to Jen first and say, so Jen, how are you dealing with the different stakeholders when you're thinking of these decisions?
Yeah, thanks, George. We have an annual governance roadshow with what we call it, with ISS and Glass Lewis, and we review our strategy, our compensation plans, progress to plans, what we're thinking about in the future, and it includes both management and the the appropriate board executives or board representatives rather, and it's now a matter of course that that we do that, which is really, really helpful because they're hearing together, management and boards as partners, board reps as partners, talking about the same thing, and they can see the alignment. The other thing about shareholders, I would say, is that I think good, high functioning boards that have that good relationship with management, management will often call upon board members to accompany them to various conferences, roadshows, to speak on certain subjects. And that's something that I know Crescent Point has been doing for a long time. So, I would argue that this is exactly the year where you probably want management and board members to show up together to talk to some of these proxy advisors and shareholders, especially around comp.
So Joanne, maybe you could help.
Yeah, I agree with you, Jen, too. Plus, you don't want to go to your first meeting with these advisors when you have a problem. So it's nice to develop a relationship with them over a number of years. ISS has already said it will closely scrutinize any special compensation and expect companies to make detailed disclosures of extraordinary events facing the company and any resulting compensation changes. I think this is a critical point. Most companies have a say on pay resolution, and the proxy disclosure is the board's one opportunity to clearly articulate the issues that they faced, the deliberations and the reasons behind compensation decisions. The board's role is to, reward and motivate key management to execute a plan that will create shareholder value. And if changes were required in order to do so, given the unique circumstances of 2020, this should be effectively communicated so that, readers can form an understanding of what was done and why. Relating to this year's disclosure, I see a couple of special issues. Firstly, the comparator group, which is, an important element in plan design and in proxy advisors analysis, may have historically been established based on, market cap or not, same industry factors. So it could be the case that your comparator companies have had a very different COVID experience. And to what George said earlier, you don't want to be comparing yourself to these companies. So if your comparator group is no longer relevant, I think this is something you should be explaining. Obviously, any discretion, special rewards, special efforts of the management team, all of that should and will have to be disclosed in detail. And, one other point, to the extent that, you know, your board is making future plan design changes, some of that may not necessarily have to be disclosed in this year's circular, but you may want to consider whether this additional disclosure would help the reader either better understand why you made certain decisions this year. You know, you're making certain decisions because you're changing them for next year, and maybe, you know, give a more complete disclosure and demonstrate that future plans will be realigned to the new business and will create a fair and reasonable compensation program for future years.
You know, one more thought here just before we close out, and we'll go to the next part of it is we always say it, but we would say it even more so this year, that if you are thinking of exercising discretion, go to the trouble of writing it out in draft. Prepare the little table that'll show the before and the after, and write down the rationale as it's going to appear in your circular, and take some thought and care in doing that, and have that available at the time that you're trying to make a decision. And when you do that and you go to that trouble, does it pass the sanity check? When you read it, does it logical? Do you feel comfortable? As you write that, or somebody does it for you, and you're still squirming in your seat, it's basically a signal that maybe you don't have the answer right yet, and keep at it until you can get comfortable one way or the other. But it's a real good discipline, because as soon as it's made public, the pressure's going to come. And if you've gone through that trouble, you'll be ready to, you know, tell a cogent story, whether it's internally, you know, or externally. And maybe we might come back later to see if anybody's had any issues on that front. But Scott, in the interest of time, we will carry on.
Great, thanks, George. So let's turn over to the goal setting function for fiscal 21. So for folks that are in a December year end, the other half of the discussion going on is how to get ready for next year, and how to think about your budget for next year, your strategic plan over the next few years, the degree to which your business maybe has had to evolve fairly quickly over the last 6 months, and how it starts to impact how you set performance goals for next year. So as I was thinking about this going into this, there's a whole bunch of threads that get connected here, right? So some organizations rolled back salaries. Are those the new salaries, or are those salaries that will be reinstated at their old level? Good question. Some organizations are looking at setting bonus structures for the next year. Well, the operating budget for fiscal 21 may actually have a lower performance outcome than was set for fiscal 20 or fiscal 19 or 18, depending upon the organization. And how does that then track to the target level of pay for that level of performance? Do you get target for that new level of performance, or do you get something different? And you can go on and on, right? So for organizations that have operational metrics within their long-term incentive plan, how do you think about those results? Because those two may be lower than they were in past years. There's just lots of different components. Even the size of the LTIP award, if you're issuing at a lower stock price than you were last year or the year before, how does that affect your dilution? And how does that affect the leverage potentially in your LTIP awards? Let's stick with, for a second, just to keep it a bit more straightforward, calibration and the short-term incentive plan. And Joanne, I was going to pass this over to you, because I think you've also lived this a little bit with your non-December year-end organization, if you don't mind.
I have. I'm actually going to talk more about the calibration of the current year's new LTIP 3-year grants and how we address the changes to those, because that was a pretty lengthy exercise. So essentially, we had pre-COVID received the 3-year budget from management, and that got subsequently recalibrated by management following COVID. And it was considerably more conservative. Admittedly, we were still in an unknown territory, and we recognized the difficulty in estimating anything with certainty. But we had very kind of long and sometimes difficult discussions with management on how to set targets for the next 3 years in that environment. And going to some of your points, Scott, about, you know, the budget being lower than prior years. So, the board was obviously concerned about approving a budget with substandard returns that were in fact more conservative than analyst consensus, or kind of, the imputed values of that, where the share price was currently trading. And they were also concerned with establishing returns that were viewed as acceptable targets for shareholders. So, that was a very big focus for the board. Management was, similarly had their own concerns, and they were focused on, volatility, the uncertainty of future revenues, and setting targets that would be considered unrealistic or unattainable by the team, because they had to, the CEO and the senior managers have to believe that the plan is fair and achievable, and then sell it to the entire employee group to motivate everybody to perform. So ultimately, it was a process of discussion and, in fact, negotiation. And, with the help of our advisors, we were able to get comfortable with the following parameters. So first, we were setting 3-year targets, one of which was EPS. The current year, I guess the board recognized the current year's EPS target was going to be reduced to account for the current environment. But as an offset to that, we increased the targets for years 2 and 3 back to the historical growth rates, with the expectation that, management would be able to, pivot and adjust where necessary to bring the business back to the old levels. And in terms of the target min and max thresholds, that was another area that we also closely scrutinized. So, the payout at 100% target was lower than what we had in prior years. But on the flip side, we increased the what was necessary to get the maximum payout. So where in the past it was a 20% increase from target, in the new plan, management has to achieve a 40% increase from target in order to receive the maximum payout. And again, that took the returns and the performance to the pre-COVID levels. So shareholders would essentially not be disadvantaged in that scenario. So, at the end of the day, both of these changes were reasonable compromises to allow management to be comfortable that target returns were achievable, yet also to allow, shareholders and other readers to understand that maximum payouts would not be made unless the company's performance returned to historical levels.
Okay. Thank you for that. And Jen, I know you've been putting your mind to this for year end and also thinking about non-financial measures. Do you mind elaborating on that?
Yeah, in fact, Scott, one of the things that we think, I think, and I think many directors think, is that when you think about the scorecard for next year, one fundamental thing has to be true, is that the goals are aligned with your strategy and mission critical things that you have to get done in 2021 that aligns with that 5-year strategy or 8-year strategy, whatever you may have. And non-financial metrics, I think, are starting to appear more because some companies are getting into, kind of uncharted territory, or they're in transition around strategy. So, one of the things that I've seen is that for non-financial metrics, it's really good to review those and get into a practice and discipline between management and the board on a quarterly basis, and ask management to come forward with specifics around how they think they're doing relative to those non-financial metrics, so that we don't get to the year end and we don't have to start creating a laundry list of things to help us with those non-financial metrics, because some of them will occur. If you're in transition and you've changed your strategy or you've pivoted, that's a fair thing to put in your scorecard. But you need to describe in a coherent story what you actually did specifically, and to have ongoing conversations around that. The second thing I'd like to say about rethinking programs is that, there's got to be some stability, I think, for both management, shareholders, and the board, particularly management and shareholders and employees and executives, on let's not change everything at the same time. You know, if you're redesigning your LTIP, you know, and maybe your target needs to be changed, or maybe a metric needs to be changed, you know, this might not be the right year to change all of that together, or to, you know, so some stability I think is also important, also for motivation for executives and employees.
Thanks, Jen. You actually answered one of the questions that came in, which is sort of how much changes should folks be thinking about? And I think you made the case for some degree of stability. So appreciate that. I'm just going to move quickly through a couple of slides that will give some answers. One question, by the way, we did get in is how many respondents? So we had about 165 people respond. And I'll just go over this quickly. We're asking, is your organization contemplating changes to its compensation plan given what's happened in 2020? Short answer is 39% say not applicable. A reasonably robust group of folks are looking at changes to the comp philosophy. That's 32%. That is higher than I would have thought, to be honest. I think a 6% group looking at peer group, that's probably pretty normal. 15%-ish looking at changes to the LTIP, and then a more meaningful number looking at changes to the short-term incentive plan. So with that quick overview, George, I'll pass it back to you to get us into ESG, diversity and inclusion, and the other aspects in impacting compensation.
Right. We didn't want to make this webinar 100% COVID related, so we're actually hitting the pause button on that and switching gears. So, and so just to set up the discussion for this part, we know in all the companies that we're associated with for the last several years that whether it's environmental, social, or governance goals are a big focus of companies, and they're out there in terms of how they service their clients and customers. They're changing how they do business. What I want to talk about here and get your views is really how is that being incorporated, if at all, in incentive plans? In other words, how are companies starting to put money in terms of pay to senior leaders and to others in the company to help support those goals? I can tell you that it is an objective that many companies have. That yes, we know that many companies, for example, in extractive industries, have had, you know, safety metrics for quite some time. Some have had some environmental objectives that are quite clear. But in terms of some of the other tougher ESG type metrics that we're talking about, especially those that get to diversity and inclusion, I'd say that we're still in the early days, although there's a lot of work going on. So, Jen, maybe I can turn to you and have you share what you're seeing right now.
Yeah, in fact, certainly Crescent Point has been contemplating this for the last few years, and we've just released last year our second sustainability report, and very proud of that. You know, one of the things that we always talk about for comp then is where do you put something like ESG? ESG in particular, I believe, and many do, is that it's such an evolving area right now. It's not exactly standardized. There are some things emerging. People are coming out with various degrees of different kinds of targets. So we've included that as part of our scorecard, our annual scorecard, but have not chosen yet, and probably maybe not, I don't know, putting it in any long-term kind of plan, because it's evolving. And if you put it in a PSU as an example right now, what you might have as ESG targets this year might be different, you know, 18 months from now. So also with some good guidance from our advisors, you know, we've kept it in our scorecard, but not in our long-term plans.
One of the debates that's going on all over the world is how do you get agreement on counting? Like what metrics are we going to use that people can all agree on some of these, and are they objective? Do we recognize them? And until that, some companies are saying until we settle on that, it's kind of hard to put the metrics into our plan. but that's the nature of the discussion that's going on. If we stick on this topic for a moment, there's a question, a very tough question that came in as we were chatting, and it essentially it's around, in this environment, how is income inequality coming into play as a discussion point, as an action item at the board level, because it's such a big part of, it's on display in North America and elsewhere. So which one of you is brave enough to take that one on first?
Well, I'll take a go at it from,
All right.
actually, you said earlier, George, I think both boards and management teams for this year, and maybe for the next couple, have to write the press release on their decisions, and they have to stare at that and then look at it from, how would an employee view this? How would a shareholder view this? How would a community that we're operating in view this when we've, maybe decimated some of the supply chain in that community and that we operate? And I think, in general, to be fair to everybody, you want to be fair. You don't certainly want to be egregious, and I don't think anybody's going to do that, but you want to be fair to management, and you want to be fair to those other stakeholders. So I think you just have to really carefully look at that and say, is this something we would be proud to send out as a press release?
We do see the struggle on boards, and CEOs are saying, look, we know there's a growing barbell distribution of wealth in our society, and we as an economic player in that, what's our role in certainly not making it worse? What can we do better? And it leads to big discussions around, human capital and how to attract and train and how to get, talent to join the organization, and outreaches. So try to get from the bottom up, if you will. And at the top down, in terms of what to do with pay, one of the challenges, first of all, it really matters which industry. Some industries are, the competition for talent is as fierce as ever. And to have the noble objective of trying to, take pay down, how are you going to do that? Like, what message are you sending to your employees if you take pay down in a highly competitive industry? How are shareholders going to, think that's a good idea? So it's a very tough challenge. There's no easy answer, but the discussions are very active. So Scott, I think we have a few minutes left to carry on with some questions.
You want to put one out there, George?
Well, I'd like to come back to one of them, and then Scott, I think some others came in, but one of the ones we touched on, it has to do with turn your mind to 21. And I was part of a discussion the other day, and somebody asked, are people taking the advantage of this moment in time to, really revamp their plans, their incentive plans to better align with strategy? And the answer we got in the forum that we're talking about was, well, that's nice, but 21 is still so uncertain. Is this the time really to be doing an overhaul? Yes, we can make some changes that are practical to the incentive plan to maybe tighten things, but that was just part of a conversation. So I'm just curious to know whether you've either in whether you're seeing, more fundamental change in the middle of this environment.
I'll take that one, George. I mean, I think it's so difficult to make changes to comp plans that management has used for many years, that, and even at the board level, no one wants to tackle changes, even though for years, maybe something wasn't perfect in your targets or your formulas. And I think that this year provides a very interesting opportunity to really take a fresh look at some of these things, because you have a situation where both management and the board are both aligned in making things better. and making changes. And whether you make, easy fixes for now, or like, Jen suggested, not trying to tackle everything, or whether you have, a long-term plan to say, okay, within the next 18 months, we're gonna go through everything in detail. I think that it would be a missed opportunity if you don't have those discussions with management and don't have a plan to make your compensation more relevant for the future, because employees will be forcing you to do that if you want to hire the best and most talented people. I mean, and to the earlier point on answering to those employees' issues, shareholders are forcing boards to be, or companies to be, better corporate citizens, but so are our employees, and the company's culture and how we treat our employees, especially with this whole new working at home environment, is very important and factors into employees' decision on whether they're going to join your company. So anything you can do, I think, to improve your plan will be well received and worth the trouble and effort.
We have,
Hey,
seen some companies, Scott, just a quick, that they have to restructure their incentive plan because some industries are so broken, you can't wait, and you have to restructure the plans because the plans that exist right now aren't going to work, not just this year, but for 2 years. And so you have no choice, but you must restructure the incentive plan to come up with something that is going to work. It's hard to do it just because you choose to. Scott, back to you, sorry.
Yeah, no worries. We do have a couple questions in here. I'll leave it up to Jen and Joanne to duke it out as to who takes it on. So one of them kind of gets back to discretion and the fiscal 20 bonus. So how does a board assess the weighting of the various financial and non-financial metrics in determining corporate performance, given the systemic impacts this year?
Jen?
Sure, I'll take that. I think, I think it depends, again, context matters and industry matters, but I think, relative to, I can only speak to some of the companies I'm involved with. If you have a scorecard that already has weighting, one of the things the board may want to discuss is, given those weightings of those categories, are there things that are more important than others? Are we going to look at some of those metrics, whether they be non-financial or financial, that might take precedent this year when we're deciding what that is? Because, COVID disrupted so many things. And I think both board and management have to look at that and say, if but for COVID or in spite of COVID, and you have to think about what those priorities are for the organization that are most important. We're used to kind of doing a bit of a mechanical thing about, 30% of our scorecards this, 20 is that. But in a year like this, I think, especially when you need to apply potentially some discretion, you really want to concentrate as a board on the things that matter most in your scorecard.
Okay. Joanne, we've got about a minute left. Is there anything you want to add on that?
I would add on that too. I mean, to the extent that the management team successfully navigated the company and protected its assets through this period, I mean, that has to be factored somewhere into the analysis of how people get paid, because it's been too critical, and the changes so phenomenal of what teams had to deal with in handling that. And from what, I'll go back to what Jen said earlier, I couldn't be more proud of every management team I've worked with, and to see how they have handled this and how they've taken care of the companies and their employees through this period. So, I mean, obviously that wasn't on the scorecard last year, but somehow it has to make its way onto it, somehow for this year in the decisions. And last, I think I'm going to end it there.
Okay.
I could talk
Well,
forever because there's so many different elements to this.
And unfortunately, we are at the end, so it's just about 1 o'clock. Thank you, everyone, for joining us. We had, looks like over 300 participants on at any one time, which is terrific. Jen, Joanne, thank you so much for all your contributions today. It was really greatly appreciated. Lori and Salam, always a pleasure to part with you guys. You do a wonderful job getting us here and getting us ready. Very much appreciated. And George and I would be nowhere without Noah and Matt to help pull together the presentation. So thank you guys. For everyone listening in, the recording will be available, I assume, either later today or tomorrow. Some people had a couple questions that we didn't get to. We will do our best to get back to you with the answers to those questions. On behalf of Hugeson and the ICD, thank you so much for joining us today. Have a good day, everyone.
Thank you. Bye-bye.